Good afternoon, everyone, and welcome to our 2025 Mid-Year Outlook webinar. It's officially summer, and we're just a few days, from the midpoint of the year. So I hope everyone is having a very good 2025. My name is Dana Vosberg. I'm the Managing Director of Advisory Services here at Manning & Napier. I'm happy to be joined by two great colleagues. First, Chris Petrosino is the Head of Investments for Wealth Management and Managing Director of the Investment Policy Group at Manning & Napier. He leads the team responsible for designing the investment solution set and setting strategic asset allocation guidelines for wealth management clients. I'm also joined by Jeff McCormick, a senior financial consultant at Manning & Napier, based in our home office here in Rochester. In his role, Jeff is responsible for managing all aspects of client relationships, including investment-specific discussions and comprehensive financial planning. So thank you, Chris and Jeff, for taking part in the webinar today.
Thank you.
And we encourage you to ask questions along the way. If a question does come to mind, please feel free to submit it using the Q&A function that you'll see on the screen. We'll spend time at the end of the webinar answering as many questions as possible. And if we don't answer your question here live, just know that we or someone on the team will be sure to follow up to answer your question. And thanks to those who did send a question in already. We received a number of pre-submitted questions, and they're really good, and they hit on many of the things we'll be covering. So it'll be good to cover that. So it's been a busy year, and through the first 5.5 months of the year, certainly a lot has happened. We could say that about really any year, but especially in the first year of a new administration that's motivated to make significant policy decisions. There's a lot that can happen, and the headlines that you see here on the screen represents really a small sample of the news we've seen so far, not to mention the very recent events in the Middle East and sort of the geopolitics that also could be added here. But in our Outlook webinar to start the year, we talked about the likelihood of volatility, and we saw some of that driven by the tariff decisions in early April. But and also with the sunsetting of most tax provisions and Tax Cuts and Jobs Act at the end of this year, or at least the scheduled sunsetting. We're seeing progress now on a new tax bill that will extend many of those provisions and then some. So, in general, a very eventful first half. So, Chris, can you please expand on that a bit as far as from a market and economic, just what we've experienced, year to date and what we've seen there? So can you just kind of talk about that, please?
Sure. No, and certainly it felt like we packed at least a full year, if not 2 or 3 years worth of headlines and policy decisions and market moving news into what's been just under 6 months. And for all of that, for all the market gyrations, all of the instability, uncertainty that we've experienced, markets domestically are largely back to where they started the year, up a little bit. Through yesterday, for example, the S&P's up just a hair over 3%. Bond yields again had some pretty violent moves over the course of 2025 to date, but again, yields are actually slightly lower than where they started the year. If we're talking about the 10-year, if we're talking about bonds broadly, investors have gained about the same as they have in the S&P, about 3% and change, year to date. So it has certainly been an interesting time where if said in a couple other settings, if you went to sleep on December 31st and woke up today, you'd think, pretty boring market environment. But certainly, reality has been different. If we just click onto the next exhibit here, I think to put what we experienced, particularly back in April, into perspective, this is the VIX volatility index for the S&P 500 going back to 2000, and it's a measure of the implied volatility based on the options market for the S&P, and as the measure would suggest, higher is more volatile. And you have to go back to early March 2020 with the onset of the pandemic, and prior to that the global financial crisis, to see levels of market volatility anything near what we experienced back in early April. And by all accounts, the announced tariff policies were far in excess of what I think even the most aggressive assumptions that we or anyone else had seen prove to be. Now, the good news certainly as April faded into May and now into June is we've seen some more cards turn over. I think we can talk more about this later. But as the market's worst fears were allayed, we've seen not only volatility calm down, but really more importantly for all of us, asset prices recover and and then some put us back into positive territory year to date.
Yeah, and I think so. Back to what you just mentioned as far as early April and sort of the Liberation Day and sort of the reaction that the market had, where I think the S&P 500 after the first, well, after the initial announcement was down 10%. I think it was 5 over the first, each of the first 2 days after that. So certainly a big reaction. And I guess we're curious about that. We're going to bring up a poll here to see what what people thought about that when it was happening. So what was your reaction? Here's what the poll says. Here, what was your reaction to April's market downturn following the Liberation Day tariff announcement? So choices are kind of the range of panic, uncomfortable but knew it would pass, indifferent because I have a plan, or unsure. So I'll give you a few seconds here to provide an answer, and then we'll move on and kind of touch on that a little bit more. Few seconds. Here we go. All right, so nice range of results here. We had a little bit of panic. Most results were kind of in the uncomfortable but knew it would pass, or indifferent because I have a plan, which is nice to see too. So yeah, so it's a good way, Jeff, to bring you in here. And if we think about volatility and just when you're talking with your clients, having those conversations of so there's a range of reactions. What are you talking to your clients about?
Yeah, I want to talk to the majority of people that knew it was going to pass, kind of understand the psyche of the administration and how things were going to evolve. It would have been great to have that level of foresight. No, but all joking aside, right? I mean, 10% drawdowns are unnerving. While they might not lead to panic, which we all have a small group of people described as being panicked over those last couple of days, they're unnerving because no matter where you are in your savings story, drawdowns in portfolio value have repercussions. If you need distributions or if you're just saving for some goal into the future. And that's why planning is so important because at the core, planning is a cash flow analysis. How much income is coming in, either from your portfolios or from your salary? How much of that is going out and what in terms of how much you're spending, and how long do you need that spending to continue? How long do you need to support that with the account values that you have? And so the analysis that we go through during planning is diagnosing those needs and then stress testing it, right? We run 1,000 scenarios, which include substantial drawdowns in portfolio value, to see how well your plan holds up. And I think, looking at the graphic on the right-hand side, one of the components that has made planning even more important over the last couple of decades is the number of households that are participating in the market. And this probably has, kind of multi-layered why more households own stocks. Definitely one is to do with baby boomers and the growth in their retirement portfolios over the last couple of decades. But another factor is the prevalence of discount brokerage and how cheap it has become to trade stocks. And even recently, with the advent of Robinhood, the gamification of stock market investing. I don't know if I can call Robinhood trading investing, but trading. So those sorts of things in that environment, stocks are inherently a more volatile asset class. So when we have these drawdowns like we had post-Liberation Day, it can lead to angst, worry, in some cases panic. But if you have a plan in place, you know that there's some safety net that you're supported by to provide comfort during that period of volatility.
Yeah, and I think it's so important to have that context where, when you have a plan, you may have something in mind where you would see, maybe a drawdown of 10%, say, and then that, somebody in their mind thinks that means it's like I'm not going to be able to retire. It's going to make it a lot harder for me. Having that context is so helpful to see the results, and actually you just stick with your plan. That may not actually really have any sort of impact whatsoever on the long-term planning that you want to try to accomplish. So that's so important. And I think
not trying to kind of diminish
Yeah.
the how unnerving it can be, but
Right.
it's something for us to reference in a conversation about, you're okay, right? Your
Mhm.
situation is okay, and here's why. Just it provides that framework.
We had earlier we had a couple charts that was just year to date S&P 500 and treasuries. Looking at another asset class here, just something to those, at least that was, hey, there was a drawdown, and then we're back up to basically where we started, maybe a little bit higher. Here's an area, international stocks, where it's actually having one of the better years year to date that we've seen in a while. So Jeff, can you maybe touch on that and what that might mean, or how to think about that?
Yeah. So for those of you that don't know, I was an analyst here at Manning & Napier for 11 years, and we were trained to look at the market globally and identify markets globally. Try to find those values regardless of geographical boundaries. And that has led to periods of time where Manning & Napier analysts are finding more opportunities internationally than they are domestically. And I think over the last couple of years, they have. So Manning & Napier portfolios are always diversified, across geographies. In some cases, concentrated in certain geographies where there's frankly more value that our analysts are finding. In terms of year-to-date performance, and specifically post Liberation Day, I'm going to defer to Chris to kind of provide some insights on why international markets are kind of leading the charge, albeit by a couple hundred basis points on domestic markets.
Yeah. So I mean, if we sort of break the year down into two parts, sort of the January up until April 2nd, right? International markets led out of the gates. And a chunk of that was a good starting point. It's something that we've talked about before, which was when we look around the world, valuations outside of the US are, considerably, lower, closer to historical average, if not a bit below, depending on the market. And so, certainly from a price standpoint, it was good. And then also an environment where many markets outside the US were at a different point in their economic cycle, whether in recession or coming out of recession, where there's sort of more of a coiled spring behind them. And so that was starting to play out going into April. And then after that, the shock with the tariffs following April 2nd, the ensuing rally, again, as Jeff mentioned, the non-US markets really led coming out of that. And this was both the relief as far as we weren't going to go from free trade to virtual trade embargoes overnight, but also the fact that for a long time, on a global basis, the US has been the place where you wanted to invest. If you were a company, an individual, a sovereign wealth fund, and you had excess capital, allocating to the United States has been a pretty good place to put capital to work, whether it's in public markets or private markets. And after the April 2nd announcements, I think companies started to maybe reevaluate over the long term, should we put all of our eggs in one big US basket? And so what we've started to see, I think, is as you reassess, well, maybe we've underinvested domestically, and that starts to open up opportunities. And so that's a tailwind that is likely not going to fade regardless of where tariffs end up. Just as we can look at markets that have been, if the US struggles as a country from chronically undersaving and overspending, we can point to other markets around the world where the opposite is true, where arguably they save too much. And so more domestic investment is going to, we think, continue to unlock opportunities on a global basis. So even despite, what leaves us now with the, global markets up about 14%, varies by market, but, 10+%, globally, we still think there's lots of opportunities, and we look in the portfolios and the analysts continue to uncover opportunities there. So we think this is a theme that likely has legs, and it helps illustrate particularly the first 5.5 months of the year, the benefits of that diversification that Jeff was just speaking about.
And that's, we touched on it several times now. Early April tariffs and Liberation Day, we received a few questions that were hitting on that as well. So let's dig into it a little bit more. And this was actually how a question was worded that came in. How does the evolving, uncertain tariff policy impact investment decisions? People are asking about that. That's probably the most common question we're getting right now. So, Chris, can you just touch on that and how that's impacting decisions?
Yeah, I think maybe we can start with just the tariff policy itself, and build out from there. It's not often you get a chart with 200 years of data, but here we are. Tariff rates in the U.S. over the years, and from our perspective, where we are likely to shake out on tariffs is probably something around the ballpark where we find ourselves today, which is sort of capturing the some of the initial tariffs the administration put on, so the 10% broad-based tariff, which largely accounts for a lot of the jump that we've seen in that tariff rate over the past handful of months. And so April, those days immediately after April 2nd in the financial markets, I think sent a powerful message that the markets really couldn't stand that those the so-called reciprocal tariffs and some of the most aggressive policies. And so those are never say never, but seemingly likely off the table. And even though we're approaching the end of the first 90-day pause, we expect you're likely to see continued kicking the can down the road. So more uncertainty. But when you think about what it takes to actually get trade deals done, they're not the type of thing you work up on the back of a napkin over a drink or two. It takes months, quarters at times, depending on the deal, a year plus of negotiation. So it's likely going to be uncertainty that we're going to continue to live with. And so what's this mean for the economy and then in turn markets and portfolios? We've seen economic data really diverge, right? Anything that's been sentiment driven has taken a hit, particularly if we're talking about businesses or consumers, is they just don't know, right? We're at a point now where some of the small businesses that we get to talk to, some of the medium-sized businesses are that went and were able to pre-buy inventory. We've got anecdotes where you're starting to burn through that, and now those next inputs that you might need are going to come in at a higher cost due to tariffs. And so there's some uncertainty, some concern there. And we'll see as the summer plays out to what degree is that those realities fully captured by the market or not. So far, given what we've seen on the volatility, it seems like the market's pretty comfortable with it. But I think there's an underlying assumption that this is going to be a non-issue, which is something that we're tracking really closely. And in the portfolio, one of the things that we did was use that volatility back in early April to position into some companies that we think have superior pricing power, where even if some of the higher tariffs were to come to light, they're in a position to put, if not all of it, the vast majority of it to their end customer. So themes like that are looking for folks with supply chains that were more advantageously positioned, where a couple of the ways that we were able to step into that volatility. But again, I think tariffs are going to be something that is a material change. I mean, even if you were to say it shakes out at, let's say, a 6% effective rate, I mean, you're looking back literally 50 plus years into the early 70s or late 60s to find anything similar. And so you know, at the end of the day, it likely functions as a tax on overall economic activity. So, you know, we think it's an environment where you want to be really choosy. You want to look for those investments that may be unfairly impacted by concerns, or you know, in some cases, find those that you know, this may be a tailwind for.
Yeah, and Dane, I'll just, in discussions, I've had a couple of clients that are kind of worried about volatility coming up with July 7th, given the 90-day pause. And, in my response, it's, don't treat that as a hard deadline. I kind of use the TikTok negotiations as a proxy here, that we keep kind of moving the goal line on when a TikTok deal might get done. And any deal, it takes two sides to make a deal, right? In the TikTok deal, it's a buyer and a seller. And I think the seller isn't willing to negotiate right now. We have plenty of buyers here in the States that are willing to pony up and buy TikTok. But it's the same thing with the trade deals. And it's why Chris said they take long time. The UK deal is an anomaly. The framework of the China deal came together kind of quickly, but it's just a framework. And even our Treasury Secretary, Scott Bessent, has said that, that July 7th is kind of a murky deadline for anybody that we're in good faith negotiations with, which is the majority of countries that are a party to the reciprocal tariff. So not to say don't be worried at all, but take the July 7th deadline with a grain of salt right now.
That's a good point. There's a good saying, in Washington, when you run out of road, you build more road, and that's talking about debt ceilings of prior years, or go back to the sequestering of spending in conjunction with that back in the early 20 teens. That tends to be what happens, and I think it's likely spot on that we're just gonna have a world that we're gonna live in for a while, and you just look for opportunities as they show.
Right.
Yeah.
And
Absolutely.
speaking of deadlines, another policy that I think is on people's minds, certainly has been in the news, has been tax reform, and they've got Tax Cuts and Jobs Act for individuals. Those provisions are scheduled to sunset at the end of this year. Congress has been working on new tax legislation there with the one big beautiful bill. Jeff, can you just kind of summarize where things stand there and sort of maybe some considerations?
Yeah, kind of, Dana, as you pointed out, post-election, this administration has been extraordinarily busy. And frankly, one of the things the market thought the administration was going to take up almost immediately was tax policy, was the extension of the 2017 tax cuts. We're finally there, right? And the president's kind of there, the House is there, now the bill is with the Senate. And it's going through the normal process of markups in the Senate to make an amicable bill that all three layers of the government can approve on. I think one thing is pretty clear, even at this stage, even though we don't have an approval on the overall structure of the bill, is that the individual tax rates are going to be maintained for at least the length of time that this administration is in power. Which provides families that are planning either estate planning or in the process of doing Roth conversions more time to execute those strategies. Beyond the length of time that this administration is in power, very likely that tax policy will change yet again. It's just the nature of government that taxes are always being negotiated, appropriate tax rates are always being negotiated. So flip a coin, red or blue, what happens in 4 years there's going to be changes to tax policy. But for now, we've got additional runway to enact or start or continue preferential beneficial tax strategies.
Yeah, and it looks like if it plays out as things are drafted here, which likely will be the case, there's people won't be scrambling to make massive changes to their plan because it looks like many of those very historically favorable tax rates and rules will just be extended a little bit longer. right? So,
Yeah, and on the business side, I mean, Chris brought it up with the small and medium-sized businesses. Obviously, one of the things, the provisions that they're looking at is the accelerated depreciation. And what that could do to spending if it makes its way through to the ultimate to the end goal. Again, some moving parts. It's still kind of written in pencil. That some things are going. It's obvious things are going to change in the Senate. What is ultimately going to change, still TBD at this point.
yeah, and that's something also that we make an effort certainly to summarize those and communicate that to our clients, and we'll have that content available when we have more clarity there, and make sure that we're proactive to share that with based on highlights, and also important if there are any important strategies, we want to make sure we communicate that as well.
Absolutely.
So if we just summarize, as we talked about where the market is and where the process year to date, or where it's been year to date, tariffs and other policy. Jeff, I'm going to start with you. Can you just kind of summarize what you think for the rest of the year as you're talking with your clients? What would you like to highlight?
Yeah, so going into the year, Manning Napier was outlining a market with increased volatility, increased concern, a little bit of concern about valuations, 2 years of 20% returns in the S&P 500, kind of historic, and that conditions were very likely to change, and they have. We're now in a kind of a street fight market, where we're gonna chop for a little while, which is going to create opportunities for active managers like Manning Napier, but it also provides additional opportunities for discussions with clients. So the discussions I'm having with clients now are, what does the portfolio dynamics look like? What is the appropriate asset allocation for you with this new reality, where we really have a true balance between what we expect in equity returns and what we expect in fixed income returns, kind of moving forward. So yeah, listen, if you haven't met with your financial consultant year to date, and you have questions about your current situation, your plan, I encourage you to do so, because we don't know what's going on if you don't share it with us. So we want to hear from you. We want to talk to you, and we want to make sure that you're in a good place. So that's kind of the discussions I'm having right now.
Yeah, Chris, so how about you as a way to summarize, or just looking ahead to the rest of the year and things to kind of be aware of and keep in mind?
Yeah, no, I mean, I'd actually go back to the tagline that we used in the promotional materials for today, the idea of stability over speculation. And I think we're going to continue to be in an environment where it's going to be tempting to speculate on the outcome of various events, whether it's policy driven domestically, or geopolitically internationally. And I think what we've seen over time is it's far better, rather than trying to spend time prognosticating which way something's going to go, and instead just be prepared. It's we were preparing earlier, Jeff mentioned the idea that this is blocking and tackling type of market, and I think that's completely true. This is one where it is, if we're talking domestically, stocks as a whole really aren't particularly cheap. That doesn't mean there's not good values out there, but you've got to work a little harder to find them, and our folks are. And then also, again, that value of international diversification, that we continue to find opportunities. We're going to keep looking for that. I think given that we're sort of back to where we started the year in terms of not only the indexes, but different levels of sentiment, volatility, things like that. I think it's going to be likely to be bumpy as we continue to go from here. Portfolios are generally positioned sort of towards their midpoint in sort of that stock bond mix for those that are invested in one of our multi-asset class portfolios, which reflects both the idea that there are opportunities in stocks as well as on the fixed income side, and acknowledging that from a risk perspective, it's an environment where a healthy dose of exposure to stocks makes sense, but wanting to save some dry powder so that if we do get a more meaningful material dust up in in equity prices, we're prepared for it to own more of those things that that we like today, and hopefully there's some other names that are on our fire drill list, and the list of stocks that we love to own that come into our wheelhouse from a pricing perspective. So that's where we are, and certainly thank everyone for putting their trust in us and the firm to manage your hard-earned assets.
Right. Well, that's a good way to end our prepared portions here. Jeff and Chris, thank you for your insights. As we move to open Q&A, again, we'd like to highlight that any questions after the fact, just feel free to reach out, speak with your financial consultant, or if you don't currently work with one at Manning & Napier, contact us and we'll be sure to have someone reach out to you. So with that, let's get to some of the questions that have come in. One that came in earlier was what's the effect of massive increasing debt and deficit on equities and bonds over the next few years? So I guess just kind of our thoughts on kind of the impact there.
Yeah. So I think this is probably one of the most frequently asked questions throughout the years I've been doing this from, and one, I think it illustrates the magnitude of deficits, particularly here in the United States, but also the fact that it is a very slow moving phenomena. There is not a magic number in the sand in terms of debt to GDP or nominal dollars of debt that reliably will trigger some adverse outcome. However, I think what we will deal with as we go forward is the potential with higher deficits, one, to pose a limit to some extent on what we can do from a fiscal perspective, trying to stimulate economies in economic downturns. So you go back, part of the reason why we were able to effectively shut down the domestic and indeed global economy during COVID, those early months, was because we went in and propped up the consumer, propped up businesses with a magnitude of spending that on an inflation adjusted basis actually outstripped the everything that went on during the New Deal. That requires a lot of debt, and that is counter-cyclical spending. That's typically what the economists, the Keynesians anyways, will tell you should do. Stimulate counter-cyclically, and when things are good, rein in those deficits. We're really not doing that. So there is a risk we get into an environment where you need massive fiscal again, and the bond markets might not let you do that. So I think you start to lose some optionality going forward, but it's also important to note that currencies and bonds are very much a relative game. When you think about it's not, you don't own dollars or treasuries in a vacuum. You own that against, do I want to own euros? Do I want to own JGBs, Japanese government bonds? It's all it's a lot of comparison. And when you look at other markets too, they're also not in particularly great shape, which is in some ways, do you have a good house on a bad block? That's that's one analysis I've seen some folks put forth, but it also suggests that you're unlikely to see rapid moves away from the dollar, away from treasuries. It may happen at the margin. We've seen a little bit of that, but there is not a clear alternative out there that offers the yields, the stability that U.S. assets offer, with vastly superior fundamental profiles and things like that. So it's something that's out there. It's something that a lot of folks are worried about. And it's usually not for them; it's for their grandchildren, or their grandchildren's children. And we completely understand it, but it's something that it does move slowly in real time, and we're likely, again, it's going to be potentially a tax on growth at the margin as opposed to some cataclysm that brings everything down overnight.
Yeah, Dana, I'm just going to really quickly, we're kind of seeing a microcosm of what might happen, because with the cost projections of the one big beautiful bill, they're looking for offsets, spending offsets. And one of the items that was brought up in the House bill is cuts to Medicaid spending. And one of the things that differentiates Manning and Napier is our ability to own healthcare or not own healthcare, depending on the knock-on effects of what a decrease in government support of healthcare services might be. If that materially impacts nursing homes or materially impacts rural hospitals, we don't have to own those. And we can make investment decisions depending on where those dollars are flowing, and when they're not flowing in that direction, we can take our money away from there. Needless to say, there's likely to be some changes in government spending. It needs to be addressed. When it will is anybody's guess, but we're kind of seeing that being played out with this bill. What makes it through the Senate, we'll see, because Medicaid cuts have been a contention with the Senate. But I just wanted to put that out there as our ability to be nimble when conditions change.
Great. Well, there's several questions that came in about asking about the Fed and Fed decisions, either, maybe the impact that the Fed could have on markets this year based on, whether or not to make a decision to cut rates. Also just, I think Fed policy thoughts. So I guess, I just kind of wanted to group them together here just because just kind of cover the Fed and maybe thoughts on how certain decisions may impact the markets.
Sure. So for the majority of this year, right, the Fed has been in a holding pattern in terms of the Fed funds rate, as they've wanted to balance, what we've seen in, some slowing in, certain areas of the economy. I think housing, being one, that continues to cool nationwide, particularly in form to some of the hottest markets. So some signs there, slowing wage growth, some signs that, perhaps there is scope to lower rates against, what we have seen is a rapidly evolving landscape on tariffs. And so the Fed, their objectives, right? It's we want price stability, i.e., inflation under control, and we want full employment. And so we've been in a market where employment's been more or less, full. Unemployment rate's pretty low. It's so that's been healthy, and so that's given them, I think, more scope, maybe than otherwise, to be a little more, discerning's the word, or just a little more careful on the inflation front. And in some ways, right, it's fighting the last battle, right? The last battle was the transitory inflation coming out of the pandemic lockdowns. And oh, don't worry, this will pass in a month or two, and it stuck around for quite a while. And so I think there's a tendency in most to want to, okay, we're not going to make that mistake again. So I think we've got about 2 cuts or so priced in based on the futures market into year end. We continue to see some things soften. Now, ultimately, when we think about, well, what does the pricing in of a couple cuts means? Well, that's not every market participant is saying it's 2 cuts. It's you've got some that are 0 and some that are 4, right? So there's it's likely to remain sort of path dependent, to use the Fed's word from there, right? So things continue to cool. I think there's scope to to see those rate hikes. But I would say that these next couple months, I think, are going to be critical from on that sort of tariff induced inflation front, right? As we start to see those goods that have left the foreign markets on ships for the U.S. have now entered port and are being loaded off of rail cars onto tractor trailers and finding their ways into stores and production facilities. You're starting to see some of the tariff impact filter through. So if we get a few more months in and it's largely been absorbed, not passed on, that'll be a win on the inflation front. If instead it spurs some additional price increases, the Fed may be justified in waiting a little bit longer. So, certainly by the time we get together to do one of these again or do some of our upcoming client receptions, we'll have some more data points on that front for folks. And just the other thing I'd add too, when we think about interest rates, right? There is the Fed funds rate that is obviously, as the name implies, under the purview of the Fed. But then we think about the interest rates that influence a lot of capital allocation decisions for both companies as well as individuals, i.e., mortgage rates, and that is largely anchors off of the longer dated maturities. So the 10-year Treasury, which the Fed has considerably less less control over. So it's I think it's been put out there by some that, well, if the Fed just cuts rates, mortgages will fall. Maybe, but not not necessarily, right? That's sort of a market-driven price, and so that's just something to keep in mind as well.
Yeah, there's a couple questions that were asking about how the market might react to a Fed chair change if Powell is replaced, which is so obviously hard to know what that would be, but that's obviously on people's minds as well.
So I think a couple elements here. One is it replaced in the normal scope of his term is up and we bring in a new chair. Certainly bringing in someone that is perceived by the market to be dovish, i.e., in favor of looser monetary policy, lower Fed funds rates. That'll be cheered by the markets. Now whether that's a short-term sugar high or not, it remains to be seen. But I think that's very different than an environment where we fire the Fed chair tomorrow and all of a sudden, throw the notion of a independent central bank into question, right? That could be very, very disruptive. So I think it's it's as much who as it is how that will determine the reaction that we see.
There's one that came in ahead of time that I just wanted to pre-submitted that I wanted to touch on. It's just sometimes you get these questions with times of volatility, but what do you suggest I do with cash that's sitting on the sidelines right now? It's a good question.
Yeah. So going back into, kind of that planning discussion, it's what are your needs, right? So, do you need that cash in the next 3 to 6 months? If so, probably keep it where it is. If you don't, then, when are you going to need it? And then we can discuss what an appropriate allocation is. But having it sit in a checking account, if it's beyond 6 months where you need that money, is pretty unproductive. So even investing in it in a short-term money market fund, you could be earning 4% on it if you're skittish about investing it in the stock market. But if you don't need it for a couple of years, then discussing what your outlook and needs look like can help us frame how to appropriately put that money to work. But yeah, cash in the checking account is a discussion that I have common with clients. It's hard to change habits. People like to see big balances in their bank account. Then you do the math in terms of how much interest they could be earning elsewhere, and they kind of change their minds a little bit.
Right. So just aware of time too, and we're going to continue to answer questions that come in. Understand some people, if you're busy and you want to jump off, that's fine too. But we'll continue to answer questions here along the way. One that I think, just back to the tariff topic. I guess the question was, you mentioned that the portfolio invested in some companies that could weather tariffs and had strong supply chains. Do you have some examples of those? Is there maybe some areas that we could sort of touch on and more specifics?
Yeah. So it's always a bit challenging in this setting, just given folks have in different portfolios. So maybe we'll talk a little more specifically thematically, and we can follow up with some particular names that would apply to your portfolio. But one area in particular that we were able to sort of upgrade into was in some portions of the luxury goods market. And you think about tiers of luxury goods, there's everything from luxury goods that sort of have mass appeal those that have, a far, a thinner market, maybe appealing, to the top, 2%. And then there is a strata that is, in the fractions of the top percentile. And so, this has been an opportunity where we were able to allocate to a couple of those types of companies where there are waiting lists for their products. And it's the type of thing where if you're on the waiting list and your name comes up and you say, no, I'm going to pass, you might not get on that waiting list again. Or you might, go back to the bottom of the list, right? And so these are the types of things we're talking about, folks with discretionary levels of income that if the price of the good is up an extra 10 or 20%, they're still going to take it, right? Because it's not, the value of that good is as much the sort of intangibles and brand associated with it as it is whatever the the cost of those inputs are. So those are a couple examples where we were able to sort of high grade the portfolio and sort of take our luxury theme up another notch. But like I said, we can get back with some specific examples relative to your particular portfolio.
Yeah, Dana, kind of going back into my analyst background, pricing power is a key condition in our profile strategy, and a number of companies in the luxury good market with, frankly, infinite pricing power. They could increase their prices and pass through their supply, their increase in input costs, and consumers would still pay it. They were on sale post the tariff hikes or the tariff announcement. And when you can buy strong companies with nearly infinite pricing power on discount, yeah, sign me up. I'll take that every day.
Good, yeah, and another one that came in ahead of time is pre-submitted, but it's a question that comes up a lot. Is just our viewpoint on Bitcoin or cryptocurrency. So maybe just both of you, we're talking ahead of time that that's some thoughts on that certainly. So if you could weigh in there.
Sure. Yeah, I mean, increasing conversations with clients about alternative assets in general, right? And what is the appropriate allocation of investable assets towards alternatives? And depending on conditions, it could be anywhere from 0 to 20% or more, if you're running a large endowment and have super long time horizons. But for standard high net worth individuals, kind of 0 to 20 is the range that we're discussing. And crypto or digital currencies are an alternative asset. So they fit in that, 0 to 20%. And, having, dialogue with multiple clients about the appropriateness of digital currencies, the volatility, the pros and cons of what putting an asset like that in a portfolio alongside a traditional stock and bond portfolio, what attributes it adds to the portfolio. Actively engaged in those discussions today. So I know I didn't give you a pound the table buy on Bitcoin or a sell, but we're talking about that in terms of appropriateness for client portfolios. Chris, I'm sure you've got something to add there.
Yeah, no, a couple thoughts. One is just, an observation of how the conversation within the research team has evolved over the past several years around crypto assets, Bitcoin in particular. I think there's been a lot of thoughtful conversations on both sides, and it's certainly an asset that's been through some a couple difficult markets, which is generally good just from a sort of stress testing a type of thing. You generally don't want to be in something that's never been put under duress before. So I think that's that's been good to see. From the conversations that I'm having with folks that think about it from an allocation perspective is it's sizing that matters, right? This is a asset that on the one hand has performed many-fold what the stock market has done over the past few years, but its volatility is also multiples higher. And any, if you have a volatility of 50, which is about what Bitcoin does last I checked, that means any outcome plus or minus 50% of where you are today should happen about 2/3 of the time, statistically speaking. And so just, being prepared for that type of volatility is important. And, thinking about, how much of something like that should be in one's portfolio. And that's where folks like, Jeff, Dana, their colleagues, I can get involved too, and just help illustrate some, examples for folks that, are interested in Bitcoin and want that as part of their allocation, but really just to help with that sizing discussion.
Yeah, risk appetite, and does it add or detract from diversification of the overall portfolio? Those are the primary elements that we're going to be discussing when talking about adding any alternative
Right.
asset to portfolios, including cryptocurrencies.
Good question came in. Let's see, about healthcare, sir, in some of the changes at HHS. But would you stay away from the healthcare segment right now? Do you think there's think that is the most volatile sub-industry given all the shakeup at HHS? So I don't know, thoughts on just kind of the healthcare and the current administration, right? It's that's something to kind of be aware of with some of some of the viewpoints coming out of HHS.
Did they know I was a former healthcare analyst? No, go ahead, Chris.
I was going to say, I was going to just sort of speak real broadly and then invite you to dive in a little deeper. But earlier, I remarked that looking at the U.S. market, it's generally on the expensive side historically, not necessarily nosebleed level expensive, but expensive. Healthcare is one of the areas that there are a lot of companies that are trading at historically low valuations. And now sometimes, many times things are cheap for a reason. So it may be, that there's not everything that, trades at a P of 8 times is something that you want to own, because that's the market's way of saying, I don't think today's earnings are going to sustain into the future. But I will say it's an area that our healthcare analysts are, we are finding opportunities and looking for those areas that are less exposed to the any changes at HHS, FDA, anything like that. And so these environments tend to give you opportunities where the baby gets thrown out with the bathwater, because I think that reaction is it makes a lot of sense. So healthcare, that's under a lot of fire. Let's just fire and forget. Let's not have anything to do with it. Let's not take the risk. And generally, when the market adopts that mindset, fire and forget, you create some good values.
Yeah, and that's largely because the pace of change in healthcare is glacial, because the regulatory market dictates that it's so. It takes so long for innovations to make their way through the pipeline that there's not a high level of disruption in healthcare. I think the big policy announcements that need to be, so they've talked about price controls on pharmaceutical drugs. That'd be bad for pharma, but I think every administration going back all the way through my time as an analyst, and I started as a healthcare analyst in 2003, has talked about price controls on U.S. pharmaceuticals. Will the Trump administration get it enacted? Maybe. I'd have to defer to Sahil on his thoughts, our healthcare analyst. But that's the big one in terms of impact on the U.S. pharmaceutical industry. I kind of talked a little bit about Medicaid. It would have a marginal impact on the investable health hospital companies, negligible impact on insurance companies, but potentially massive impact on nursing homes. So yeah, there could be some impact, but again, we have the ability to be nimble, identify opportunities when others are just kind of throwing a wide net and saying, "Oh, bad, run away." No, those are where the best opportunities are typically found.
Time for a couple more here. We'll see. This one is, what is your current attitude toward long-term treasuries at this point in time? So I guess investing in long-term treasuries.
Sure. So we think that you're being compensated for the duration risk that you're taking, that interest rate sensitivity. So we look in the portfolios. We have may propose will have some long-term treasuries, but it's as part of your overall fixed income exposure. So, it's not an environment where we want to be, massively overweight long-term treasuries, because they're still, we think while you're being fairly compensated, excuse me, it's not necessarily a back up the truck moment on it either. So again, when we talk about diversification, spend a lot of time on the equity side, right? In terms of sectors, in terms of geographies, but the same applies in fixed income, right? When we think about, well, what can we own? Well, we can own treasuries. What maturity treasuries do we want to own? We can own corporate credit. We can own agencies. And we can own asset-backed securities. And so it's really, achieving that same level of diversification. And, really where we sit today, we think it's, fairly valued on the treasury side. Corporate credit remains, exceedingly, we'll say well bid, which is to say that the credit spreads, that additional premium you get for lending to, investment grade and high yield corporates is, back down to fairly, fairly low levels. So when we look in portfolios, you'll see, where we have the ability to vary those exposures, we're on the light side, and intentionally so, waiting for some better valuations there.
And then there's a question, this international related, but does the firm have a point of view of investments in BRIC countries?
So the R for Russia, I think that is still a no-fly zone by some government executive orders. So we we'll honor those as we must with any directive like that. I think India, China, Brazil, we have exposure to those markets in our portfolio. So again, it tends to be less of a we want to go all in on country X, Y, or Z, and much more looking for those companies that are favorably exposed to either trends playing out in those particular countries, or what we often see is a just because the company's incorporated in one particular market, a lot of times their revenue will be derived on a global basis. So there is no sort of bias for or against any of those countries when we think about looking for opportunities. It's largely a function of applying those investment strategies that Jeff had referenced earlier. And if we find companies that tick those boxes and are valued such that we think we're compensated for owning it, we're going to own those.
Well, I think we're going to end there for today, but thank you again, Chris and Jeff. And I want to thank everyone for taking the time out of their day to be here with us. We'd greatly appreciate it if you could take a few seconds to fill out a survey that we have linked in the chat section, so we can have some feedback on this webinar. And also, if you're interested in learning more about Manning & Napier, please visit our website to schedule a call or subscribe to our content. We're also happy to provide a free consultation where you can really outline your financial situation and talk about your goals and what you have in mind for your finances, and we can prepare a financial plan that will serve as a great way to outline next steps for you to ensure that you stay on track. So please feel free to take advantage of that. And on behalf of my colleagues, Chris and Jeff, the Manning & Napier, thank you again and have a great day.